Hello friends. Last week in my video, we discussed whether the markets were preparing for a fall and whether bulls were going to be able to rescue the markets, push it up and defend the downsides. And this is what I said. So if you were to ask me, where is my bias tilted? I would say I'm slightly inclined towards a decline. Well, that said, the markets really recovered very spectacularly on Friday, and that was the single most reason why the Nifty and the Bank Nifty have recorded positive moves or week on week gains last week. Now, A, was it short covering or fresh buying on Friday? B, can markets really go up from here, test all time new highs, and keep on rallying further? Now, let me answer part one of the question. Was it short covering or was it fresh buying? Now, the weight of evidence that I collected was that prima facie it seemed to be short covering. As I wrote in my post-market note after Wednesday's trading session, because Thursday was a holiday here, I wrote that there would be feeble amount of fresh buying support, but there would be short covering coming in. The fact that the markets opened up with a bullish gap on Friday morning basically triggered a lot of short covering. That is borne out by the fact that MWPL went down on Friday as compared to Wednesday. Now, where do you get this data? In my post-market summations, which I put up on all my social media accounts, particularly my Telegram channel, first, foremost, and always. Can the markets build up the rally from here? Yes, I think they can, but provided certain conditions are met, and once those conditions are met, the bulls will be back in the driver's seat, and we are going to take exactly those conditions in our statistical analysis in this video. So let's proceed, and on your screen right now is the weekly market roundup window. It tells you that the broader based Nifty 50 led the rally upwards, whereas the Bank Nifty just about managed to close with gains by a whisker. The US dollar index went down fairly sharply, and that triggered buying in bullion and other industrial metals. Crude oil just about managed to hold on to mild gains, whereas natural gas came down. I've been posting a lot about energy, especially all commodities, on my free Telegram channel. Do connect with me there. The Indian rupee gained marginally against the dollar, and primarily because the dollar had weakened significantly against the global basket of currencies. The Indian 10-year benchmark bond yield went down by 1 basis point, which means bond prices went up marginally. That was one of the reasons why the Bank Nifty went up. NSE gained almost 1/3 of a percentage point in market capitalization. That tells you that the rally was somewhat broad-based. MWPL went up by 1.24%, which is routine in up to the third and even in the fourth week after the expiry of the prior month's derivative series. And the US markets went up, and the technology-heavy Nasdaq was the biggest gainer last week. That provided tailwinds to our markets. Friends, now I share with you the ratio chart, which I have been sharing since the last few weeks. This is the Bank Nifty ratio versus the Nifty 50. Why do I share the ratio chart of the Bank Nifty versus the Nifty? Because the banking and financial sector stocks enjoy a weightage of more than 34% in the Nifty. So these stocks, this sector itself is a swing sector for the Nifty. Whichever way the banking and financial sector stocks go, that way the Nifty typically should. If there is a divergence, there will be mean reversion in the coming future. Mean reversion is one pulling the other towards itself. So they can't diverge for too long. And now what you're seeing is that the Bank Nifty versus the Nifty 50 ratio fell to its lowest after 7th of March 2024, which means the Bank Nifty continues to underperform the Nifty 50. It's not a great sign, not when the weightage of the banking stocks is so high. Now, this is one condition that I want to be fulfilled. before the markets can go up significantly from here. First of all, your banking and financial sector stocks must do very well. Friends, I now come to our in-house indicators. I start with MWPL, which is nothing but the extent of exposure utilized by traders as a percentage of exposure allowed by SEBI. Now, the exposure is at a high in the period covered by this chart, which is 20 weeks. Remember, it had crossed even 43% on Wednesday. Now, on Friday, there was profit-taking, reduction in exposure, which is why you're sub 43%. But at 42.91, there is a huge amount of expectation-based buying and short selling both, because one is a counterparty for the other, which means volatility will be extremely high, because when one of these parties squares up their position out of sheer duress of loss, prices will make outsized moves. So do watch out for that, please. Now, the second study is the stock and index futures turnover. Remember, these are three concurrent series, so it is August, September, and October. Turnover fell logically because last week was truncated due to a holiday on 15th of August. But the fact remains that in spite of the holiday, the turnover seems to have fallen a little more than what it should have been for a 4-day week. So participation levels were also slightly down. Now, friends, I come to the advanced decline ratio, which after the price is the most leading indicator of which way the winds are blowing. And the advanced decline ratio fell from 1.40 to 0.99. That means for every 100 losers, there were only 99 gainers last week. Not good news. This ratio must stay above 1.0 all the time for the markets to hit new highs. Friends, I now come to the Nifty and Bank Nifty prompt month basis. Basis is nothing but the premium or discount prevalent on the futures as compared to spot. Exactly like options premium, the basis also contracts over time, and the closer we get to expiry, the more basis goes down towards the spot. For both indices, which means that at lower levels, particularly on Friday, there was a good amount of short covering seen on declines. Now, friends, I come to our exclusive in-house indicator, the impetus. You won't find this anywhere on the internet. You've been enjoying it for almost 4 years now. The impetus is the momentum or the force in any move that is prevalent in the markets, and both the Nifty and the Bank Nifty impetus has fallen, in spite of the fact that both these indices have logged week-on-week gains. That tells me that force in buying was absent, in spite of the fact that Friday saw spectacular gains. Now, the second reason and the second condition that I want to be fulfilled before I can say that the markets are heading to a new high is both the Nifty and the Bank Nifty index should go up with rising impetus readings. That said, let's go to the final indicator, our exclusive in-house indicator, the lift, weight, thrust, drag indicator. You won't find this anywhere on the internet. Now, friends, the Nifty clocked smaller gains last week at 0.71% as compared to 1.79% of the prior week. The LWTD indicator surely went up from minus 0.06 to 0 itself, which means it's gone there and become neutral. It's sitting on a fence. It's not able to make up its mind. And therefore, I would say that this is a draw. Now, friends, I come to the bond market, which is very close to my heart. I've been telling you that bonds are an asset class that fuels the prices of other financial assets. Now, bond yields went down by 1 basis point last week, and see how the bond yield structurally as a chart and as a data point is under pressure. It's constantly down. Now, we are at 2.25 year lows where Indian 10-year benchmark bond yields are concerned, which means bond prices are up. Now, as I've been pointing out on my Telegram channel exclusively, what I have been sharing with you is the way HDFC Bank, Bank of Baroda, SBI are all raising fixed deposit rates, and therefore I'm not convinced that the interest rate cycle in at least India specific seems to have peaked out. We might just stick around at these levels for a while before the RBI goes out and cuts. Let's watch this space. Friends, the bond market's done. I now come to the Bank Nifty, and as you can see on the daily chart on your screen, it gained very marginally and logged gains on 2 out of 5 trading sessions last week. The price remains below its month-long moving average, which itself is sloping down. The 51,100 round number remains the short-term hurdle, which is the gap down which is left on the open of 5th of August. Unless this gap is filled, you're going to have trouble with the sustainability of any upthrust. Now, that also means that there would be some element of overhead supply coming in from traders who've gone long at higher levels and are stuck holding and nursing paying mark-to-market losses. Coming to the weekly chart, we see that the 25-week exponential moving average has acted like a reliable support for the second week in a row. The candle formed on the weekly chart is a bullish hammer that tells you that lower levels are attracting buying and or short covering. The 49,600 level needs to be watched in the coming week as a short-term support for now. The fact that this sector commands 34% weightage in the Nifty 50 means that Bank Nifty must gain before the Nifty can continue to make higher highs and continue to make new lifetime highs. This is condition number 3 before I can say that the markets are headed sustainably higher. Friends, in the week before last, this index was number 5 on our most volatile counters list based on statistical beta rankings that I maintain in-house. It fell 2 notches to number 7, so challenge levels came down. Always welcome. Last week, I advocated an estimated range at 52,050 on the upside and 48,900 on the downside, which held very well. In the coming week, I expect an estimated range between 52,050 on the upside and 48,975 on the downside. Also, please refer to our daily, weekly, and monthly pivots that I update on our free Telegram channel. The tutorial video on how to use our pivot levels is in this video. Hyperlink to all the videos I want you to watch are in the description below this video as well as in a pinned comment below this video. Friends, the Bank Nifty done. I now come to the Nifty 50, which was marginally stronger where gains are concerned. And as the daily chart on your screen tells you, this index gained only on one day out of the 4 trading sessions last week, but it was enough to make the index log weekly gains. That was Friday. The price has closed above a month-long moving average after 8 trading sessions below it. Now, relatively speaking, I reaffirm my view that the chartical formation of the Nifty is relatively stronger as compared to the Bank Nifty. And the Bank Nifty must catch up or it will start to drag the Nifty 50 as well. The weekly chart on your screen shows the price comfortably above its 25-week exponential moving average, which is a 6-month-long holding on cost of an average bull. So the medium-term outlook is also positive for now. Last week's candle was somewhat larger bodied, so bulls showed increasing risk appetite. Now, this must be followed up by aggressive buying support if the trend upwards is likely to sustain. Friends, in the week before last, this index was number 8 on our most volatile counters list based on statistical beta rankings. This index also slipped 2 notches to number 10, always welcome, which means volatility went down. Last week, I advocated an estimated range between 24,950 on the upside and 23,750 on the downside, which held perfectly well. In the coming week, I estimate a range between 25,125 on the upside and 23,950 on the downside. Also, please watch our daily, weekly, and monthly pivot levels that I share in the Telegram channel of ours. And the tutorial of how to use these pivot points is in the video up here. Friends, the Nifty 50 done. I now come to the last bit of statistical analysis where I will gauge the risk appetite of the retail sector based on the turnover contribution of the 4 segments in the F&O space. Coming up on your screen is a weekly chart which tells you that the index future contributed 2 basis points lower of the overall derivative turnover. It's indicated as a blue line. Stock futures turnover fell a sharp 7 basis points, which is shown as a red line. The fact that high risk, high capital intensive, high span margin requirement in the future space saw a demand fall for traders in the future space, that tells me that risk appetite was lower. Let's go to the index option segment that shows the index options contributed 7 basis points higher turnover last week as compared to the prior week. It is shown as a green line. And the stock options turnover went up by 2 basis points, which is shown as a purple line. Net, I can only call this kind of a risk appetite as poor. Although I'm willing to lend a benefit of doubt because the week was shorter last week and people may have been traveling due to the extended weekend. Friends, I now come to my own strategy for trading in the coming week ahead. I would continue to stick with public sector units. Amongst the public sector units, public sector banks, oil marketing companies, power generation and distribution companies, and energy counters. The two-way movement that these counters will provide will give traders ample amount of trading opportunities in the week ahead. Now, with winter contracts getting active in the commodities segment, action will heat up and it is the busiest time of the year for veteran traders. Now, theta decay players are likely to make a fruitful winter in 2024-25. Base metals are in a pullback move right now, and the month end may just see some amount of short covering coming in, which means the share prices of metal mining companies might just go up in the absolute near term. Bullion remains bullish in my opinion, and if you can bear out the short-term volatility, the long-term picture remains bullish and intact, especially after the US elections are done and dusted in November 2024. And like I said before, I'm in no hurry to get into gilt funds right now because banks are upping the ante and raising interest rates. So as and when I do make a point or do make an entry into more debt allocation, I assure you it will be put up on our Telegram channel. Before I wind up this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. In the comment segment, do let me know how my videos are helping you become a better trader. And please, share my video with smart traders like yourselves in social media groups, in your friends and family contact list, so that I can reach out to a wider segment of the knowledgeable audience. I thank you for your patience in being with me in this video. Till we meet again in my next. This is Vijay Bhambwani signing off for now. I wish you have a very, very profitable week ahead. Take care. Bye-bye.